Okay, so in this video, I'm going to talk about tax, and in the next video, I'll talk about subsidies. Okay, so let me draw the graph. This is demand curve, this is supply curve. Okay, so now let's say I impose $1 tax on suppliers. So the supply curve will shift upward by exactly $1 because the marginal cost of selling for the supplier will increase, you know, by the sum of the marginal cost of production plus the exactly $1 tax. Okay, so the supply curve will shift upward by exactly $1. So it will parallelly shift upward. So let's say this is our new equilibrium point, new equilibrium, and this was our old equilibrium. Okay, so the equilibrium quantity has decreased now due to the tax. And what is the amount of tax? So when we draw a line, vertical line segment from this point on the old supply curve, then the length of this vertical line segment will give us tax. So this is the amount of tax. Okay, and you know the vertical distance between the new supply curve and the old supply curve is same because these two are parallel. Okay, now what is the price paid by buyers? So this is the price paid by buyers. And what is the price received by sellers? So this is the price received by sellers. Okay. Now you can notice that let's say this point is C. To maintain the consistency, let me write with the same color. So now you can notice that along the demand curve, the point has moved from A to B, right? And along this same original supply curve, this is our original supply curve. So along the original supply curve, the point has moved from A to C, right? So the burden of tax has been shared on both the parties, right? On both buyers as well as sellers. So what is the tax burden on buyers? So since along the demand curve, the point has moved from A to B. So at point A, this is the old equilibrium price, right? So this was the price paid by the buyers initially, but now they have to pay this price, okay, at this equilibrium. So their price increased by, okay, let me draw. Okay, so their price has increased by exactly this amount, right? By exactly this amount. So this is the tax burden on buyers. So tax burden on buyers. And what is the tax burden on sellers? So for sellers, along the original supply curve, the point has moved from A to C. So this is the amount of tax burden on sellers. So tax burden on sellers. All right. And we normally write tax burden as the percentage in the percentage form. So how do we convert it in the percentage? So tax burden, let's say the percentage of tax on buyers is simply the tax burden on buyers over total tax, which is the whole, the length of the vertical segment BC. Okay. And for sellers, the tax burden on sellers over total tax. That gives us the percentage of tax burden on sellers. All right. And we have a separate name for the length for the tax, that is the length of BC. We call this wage. Okay. Wage. Tax wage. Okay. So the length of BC is tax wage. All right. Now let's tax the buyers. In this graph we tax the suppliers, so the supply curve moved upward and left, right? Now let's tax the buyers first. Let me draw another graph. So this is our demand curve, this is our supply curve. So when I impose the tax, let's say $1 on buyers, then the demand curve will shift downward. Why? Because the willingness to purchase will decrease by exactly $1, because they're going to pay the $1 tax, right? So the original demand curve will shift parallelly to the downward, to down. So let's say this is our new equilibrium. New equilibrium. And this was our old equilibrium. So again, you can notice that the equilibrium quantity has decreased. So whenever we tax either buyers or sellers, the equilibrium quantity will decrease. Okay. So this is the quantity after tax. And this is the quantity before tax. Okay. Now, what is the amount of tax in this case? So again, you draw a line from this point on the original demand curve, and let's say this is C. So this is the amount of tax. We call this tax wage. Okay, so this is tax wage. All right. Now, what is the price paid by buyers? So this is the price paid by buyers. What is the price received by sellers? So this is the price received by sellers. All right. Now, what is the tax burden on buyers? So this segment gives us the tax burden on buyers. Tax burden on buyers. All right. And what is the tax burden on sellers? So again, the other half gives us the tax burden on sellers. Okay. So from these two graphs, you can notice that no matter whom you tax, the tax burden is going to be shared among buyers and sellers. Okay, so it does not really depend, the tax burden does not really depend, the tax does not really depend on the buyers or sellers, whom you tax. It does not really depend whom you tax. Okay, so the tax is going to be depend on the elasticity. Okay, so who pays the tax does. Okay, let me write the remarks. So the first remark is, who pays the tax does not depend on who writes the check to the government. Depend on who writes the check to the government. Okay, so it does not depend on the buyer or sellers. Second remark says who pays the tax does depend on the relative elasticities of demand and supply. Relative elasticities of demand and supply. The spelling is mistake. Elasticities, okay, of demand and supply. All right. So now, okay, so let me draw another graph. Otherwise, it will be very messy if I explain from this graph. This is our demand curve, and this is our supply curve. All right. And let's say this is the tax wage. All right. So this is the price paid by buyers. This is the price received by sellers. And this is the old equilibrium. Okay. Let's say this is A. Now, I'm going to explain basically the second point, how it is dependent on elasticities. Now, let's say I rotate the supply curve. Okay, so this is supply, this is demand. So I rotate the supply curve in the clockwise direction. So how will the waves move? So now you can imagine this thing. I cannot show you here, the 3D motion. So you can imagine this in your mind. So whenever I rotate the supply curve in the clockwise direction, so the tax waves will shift to the left, right? It will shift to the left and upward as well. So this will shift to the left as well as upward. So in this case, the tax burden, so this will shift to the left and upward. So in this case, the tax burden, let's say, okay, let me draw let's say the supply curve has rotated to this point. So now you can see that this is the amount of tax burden on supplier. Okay, initially it was the whole segment. This whole segment was the tax burden on supplier, but now the tax burden is only the length of this segment. So you can see that the burden on the supplier has decreased. And when I rotated the supply curve in the clockwise direction, this means that the elasticity has increased. Okay, that the flatter the curve, the more elastic it is. So when I rotated the supply curve in the clockwise direction, it became more elastic. So the more elastic the curve is, the less burden, okay, will it be on. So the suppliers will have less burden. And the similar argument with the demand curve as well. So whenever I rotate the demand curve, let's say in the anti-clockwise direction, then the burden on the buyers will be lesser compared to the burden on sellers. Okay, so this explains that the tax depends on relative elasticities of demand and supply. All right, let me write the remarks. So the less elastic side of the market will pay the greater share of the tax. The greater share of the tax. All right. So if the curve is more elastic, there will be less burden on either buyer or seller. Okay. Now, let me give you a formula which will help you to calculate the percentage tax burden on buyer or sellers. All right. So the percentage tax burden on buyers. So to calculate this, we have a formula. The absolute value of the slope of demand curve. You know that this for the demand curve it is negative, so we take the absolute value divided by the slope, the sum of the slopes of both curves, supply as well as demand. So plus, and the slope of supply is positive, so we don't need absolute sign. So this is the formula for percentage tax burden on buyers. Okay, and for percentage tax burden on sellers, we have slope of sellers divided by slope, absolute value of the slope of demand, slope of supply. Okay, so this is so these two are the formula for the percentage tax burden on sellers. You can also write this formula in the elasticity form. Okay, so we can write this formula in the elasticity form as elasticity of supply divided by the elasticity of supply plus absolute value of the elasticity of demand. And for this one, elasticity of demand divided absolute value plus elasticity of supply plus absolute value of elasticity of demand. Okay, so you can remember these formulas. It will help you to calculate the percentage tax burden on buyer or sellers directly, and we'll do many more questions in the coming videos using these formulas. Okay, so that's it for this video. Thanks so much for watching.